Hi everybody, my name is Kyle Patterson from Bryson Insurance, and today we are running a webinar on effective cash flow management during the COVID-19 pandemic. We are very grateful and happy to be joined today by Scott Sonley. Scott is the Vice President of Baker Tilly KDN Consulting Inc. Specifically, he is a business valuation specialist, and he helps people with additional financial modeling like what we're going to be going through today. Scott lives in the Durham region with a son and twin daughters. We have a lot of content to get through today, and with that, I'm going to toss it right over to Scott so we can jump right in. Please ask your questions as we go, but we're probably going to be answering those questions when we get to the end. So you can feel free to ask them, and I'll be taking track of them, and we'll see how many we can get to. Okay? And I will deal with the people who are saying they cannot hear us right now while Scott gets going.
Okay, because I was seeing that in the comments. So hopefully everyone can hear me to start with. If not, there'll be a recording of this later on too. So, all right, everyone, welcome to our presentation on effective cash flow management during the COVID-19 pandemic. Again, my name is Scott Sonley. I'm a Vice President with Baker Tilly KDN, which is a public accounting firm offering a full range of accounting, taxation, and advisory services. Our firm has offices in the Durham Region, Cobourg, Lindsay, and Peterborough, or also across all of Canada. While I'm an accountant, my role within our firm is very different from most. I do not assist in the preparation of year-end financial statements or corporate or personal income tax returns. My main role with the firm is to lead our business valuations practice. In addition to that, I assist a number of clients in preparation of projections, forecasts, budgets, or other forward-looking projects as required. So when Kyle reached out to me to see if someone could lead a presentation on effective cash flow management, I knew I presented on something similar, and I keep all my presentations mainly to make sure that when I do these things, I can save some time. That topic, I had to go back to my notes to find it, was called Weathering the Storm, and was presented all the way back in 2008 during the previous financial crisis. So managing cash flows becomes top of mind for all businesses during downturns, but it's something we really don't think about at other times, and we really should be. So I'm going to start my slide deck now, so hopefully everyone can see this moving forward to our disclaimer. I'm not going to read this verbatim, but I will leave it on the screen for a couple of seconds here for everyone to read. I believe everything in this content is current up to April 21st, 2020. I don't believe there was any significant announcements yesterday. I haven't heard of significant announcements today, but they'll be coming, I'm sure. Okay, next slide. I've also included here our landing page for COVID-19 business guidelines. This webpage incorporates all the latest updates to COVID-19 tax and financial measures impacting Canadian businesses. It's also separated down to the provincial level. It is being regularly updated for changes. So I believe it's up to date to, again, April 21st. There may have been changes today, I haven't checked. One thing I will say is there's a massive number of government announcements that have come out and changes to those announcements too. So it's very difficult for business owners and even accountants to keep up with what's changing. I came up with this little bit of a tongue twister when I was thinking about what to present today, and what is known today differs from what we knew yesterday and will differ from what we will know tomorrow. So let's get into the content, okay? And we're gonna start with the cash conversion cycle. And I ask you to bear with me for a few minutes because I need to give some background information, but I promise I'm gonna get to the point, okay? So visually, we're gonna take a look at this, and for this presentation, you wanna start at the top at the cash, go around this image in a clockwise direction, and at the very beginning of any operating cycle, we start with cash. Moving around, we need to purchase our inputs in order to, such as raw materials, to support our production. We're going to then process those inputs into our product or service, which we sell to our customers. And then the cycle ends when the cash has been collected from our customers. So the cash conversion cycle, very generally, is the length of time for any company to convert its cash invested in operations to cash received as a result of its operations. And there's three components to the cash conversion cycle, and that is days inventory outstanding, days sales outstanding, and days payable outstanding, okay? Very briefly, from a mathematical perspective, it's pretty simple. The cash conversion cycle is the days inventory outstanding plus the days sales outstanding minus the days payable outstanding, and the formulas are provided on your screen there. But looking at that, it really doesn't explain what it is. So I tried to put this back visually again to see this is what it actually means. Okay, so the overall operating cycle is the number of days from the day we purchase our materials on account. Let me see if I can put on my drawing pointer, from when we purchase materials on account to the day we collect our accounts receivable. Okay, so in this particular scenario, we're talking 80 days. It takes us 30 days from the day we purchase our materials to selling our finished goods on account again, and then 50 days for us to collect on those receivables. Now, at the same time, we don't actually purchase our materials, so we've bought them, but they're on account, so we don't pay for them until 40 days. So the cash conversion cycle in this scenario is 30 days plus 50 days, which is our total operating cycle, less 40 days. And this is the section that we're concerned about. 40 days is the amount of time it takes us to, from the time we pay for all of our supplies to the time we have to collect again. And this is important because at the end of the day, we have to maintain our working capital for these points in order to support our business operations. Now, when I bring this, and let me just undo all this. By the way, could everyone see when I was circling things? I haven't used this before. I'll keep going while people are saying that. Now, if I bring this concept up to a business owner, I normally get met with a pretty blank stare. At the end of the day, they say, why should I care about this? And they're probably, so many business owners will focus on net income or revenue in their business, and their businesses have run very well for many years. Why does this matter to them? So a simple example, a business owner may tell me that we know we can do $1 million in revenue every year. That will result in $100,000 of after-tax net income, and our cash position will be improving year over year. That's enough for me. And it's likely they're correct. You create shortcuts and rules of thumb to measure performance in your own businesses, and you're very likely to be accurate in that. Now, the issue is that's all been done previously when times are good. And when times are good, over the long run, over a long period of time, mature businesses with reasonably consistent earnings and stable balance sheets, which includes accounts receivable, inventory, and accounts payable, the cash conversion cycle may not be important. But I'm going to give you now a simple example here and try to explain why it should be important to you. Okay, so we're going to go through this example in a little bit of detail because we're going to use Acme Incorporated throughout. So we're going to come back to this example later on. So Acme Incorporated has $6 million in revenue annually for the last 2 years, 2018, 2019. Cost of sales are always a standard 70% of revenue, which makes our gross margin 30%, okay? All those cost of sales are variable, 100% variable. They vary in proportion to revenue. Our operating expenses at $1.2 million per year are 100% fixed costs. So then it's pretty easy to calculate the pre-tax earnings in our business is $600,000. And all this is shown on the right-hand side here in detail. If you can't see it, you can zoom in on your slide deck, and hopefully I can show this a little bit easier. After we get to pre-tax earnings, we also calculate the taxes, and we can show that this business made $511,000 of net income after taxes each year for 2018, 2019, okay? Zoom out. Going on to the balance sheet, Acme Incorporated's customers pay in 2 months. So that's a 61 days sales outstanding. And so based on standard level of sales and assuming it's earned across the entire year, gives us $1 million in accounts receivable. Our inventory on hand is also 2 months of production, which calculating quickly, it's $700,000. Accounts payable are paid in 2 months, so $900,000. And for this example, I've specifically assumed that accounts payable were 2 months on all expenses, not just the cost of sales, which is the way it's calculated for days payable outstanding. Overall, Acme Incorporated has $800,000 of cash tied up in working capital, which is just the $1 million plus $700,000 less $900,000. assets plus asset minus liability. So we're using cash to support our operations. And that's going to be important later. So two other assumptions that are important here is, slide's not moving, okay. In this particular example, any capital expenditures are equivalent to depreciation or amortization, and the company does not have any external debt, or if it did, any principal repayments are offset by additional new debt. Okay, so the cash flow for Acme, or for any business for that matter, the cash flow for any business can be really broken down into four main categories. We have cash flow from operations, which is just our net income after taxes, plus or minus any non-cash items such as depreciation or amortization. We have any changes in our working capital year over year or period over period. And we have investing activities such as the purchase or sale of capital assets or other non-working capital items. Then we have financing activities such as debt repayments, new financing, share capital transactions, dividends, etc. Okay. In this specific example, based on the factors I put in place, the 2019 net income after taxes is exactly equal to our cash flow from Acme. Now that's mainly because we assumed there was no balance sheet changes over period. So again, back to my point here, in good times, when things are good, and you can read this as 2010 to 2019, if a company's balance sheet was reasonably consistent between periods, whether considering months or years, net income may have been a reasonable approximation for cash flow. Unfortunately, if a business changes significantly, such as an early stage business, a high growth or declining business, and I'm putting here, or most businesses during this COVID-19 period, this approach may not work. And the problem is that along with a reduction in cash flow from operations, it's likely that your cash conversion cycle will be significantly impacted. Okay, so when times are bad, what we're going to see in the coming, or probably already seeing now, is that outside forces are going to put pressure on our balance sheet. Factors outside of our control are going to lead to increases or decreases in certain things. So days inventory outstanding, most businesses are likely going to see a slowdown in near-term production, and as a result, days inventory outstanding will increase. That results in a use of cash. As other businesses, our customers, are impacted, their cash flows are going to be impacted, and they may request or unilaterally take additional time to pay accounts receivable, which will result in days sales outstanding increasing, again, a use of cash. And then as our cash flows are impacted, we may need to consider requesting additional time to pay our suppliers, which results in days payable increasing. Now that actually results in a creation of cash, but it's unlikely to fully offset the other uses of cash we've just talked about. So if we revisit our Acme Incorporated example, what if instead of 2 months, or let's just say things change by a month for each of them? How does that impact our cash flow? So if calculating the change for 1 month is relatively simple, it's just really 1/2 of each of the other calculations. So $1 million in accounts receivable is up or down by $500,000. Inventory, $350. Purchases, accounts payable, $450. Okay. If we're going from 2 months to 3 months overall, instead of $800,000 cash tied up in our working capital, now we've got $1.2 million. That is going to be a use of $400,000 of cash. If we go the opposite way, we've managed our business better, which I don't expect to happen through COVID-19, but you might have done previously, you could have created $400,000 cash. So what's the point? Get to the point already. If you take nothing else away from all this discussion we just had on the cash conversion cycle, it should be this. As business owners, we should not be focusing solely on revenue or net income to measure performance of our business. This is particularly true in trying times. We should be managing our balance sheet at all times to improve cash flow for our business. However, when times are good, this may be overlooked and not have a significant impact on operations. When times get tough, forces outside of our control will put pressure on our cash flow. We'll need to be actively managing accounts receivable, inventory, and accounts payable, as well as any other assets and liabilities on our balance sheet or risk running into a cash crunch. So the next section we're going to talk about is forecasting. And you'll see I've called it forecasting here. You might hear me refer to it as forecasting, projecting, modeling. At the end of the day, I'm not concerned with what you call it, but you're going to need to build something that will help you understand what the impacts of this situation, or even in general, you should be building them, but for COVID-19, what impact that's having on your financial statements. And I'll be the first to admit that building a model to predict your balance sheet, your income statement, and cash flow at the best of times can be difficult when things are going well. But it's even more difficult in the current environment. So the purpose of this model, whatever we're building, it's not about predicting exactly where we'll be in 12 months' time. There's simply too many unknowns right now to accurately forecast that far out. Instead, we're going to be focusing on what we know or expect, and then have the ability to make changes as they occur, and changes will occur based on what's going on right now. Cash and cash flow should be our focus. And in particular, are there sufficient cash reserves or financing available to get us through to our next cycle, to when this ends, hopefully? Some recommendations for this process: you need to be building a model that details both the balance sheet and income statement. I'm seeing examples that are coming from different sources that are focusing on just the income statement and ignoring the balance sheet. And again, previously that could have worked, but I expect that you're going to see significant changes to your balance sheet, which are going to impact your cash flow. And in a few minutes, hopefully I'll be able to show you an example of where we actually see that. So if you can build it, my recommendation would be to build a cash flow statement as well, that just basically shows where cash is expected to go or come from over the course of whatever period you're building it for. If you can build it, you want to be building at least monthly. It's not something we can build for the entire year. We want to build each month for the next 12 months and build it out. Some people are recommending or seeing that they need it more detailed than that. So they're going from monthly down to a weekly to see where their cash flow is really most impacted and where things are going to be, not over the course of the next month, but over the course of the next 4 weeks, and seeing what inside that 4 weeks the cycle looks like. And this won't be something, it's not going to be a static document. It's not going to be something we build once and then that's it. We're going to compare that to our results at the end of the year. Rather, you're going to build it such that it has the ability to adjust and modify and revise over time to deal with changes that are coming. And there will be changes again. My recommendation is not to be overly optimistic, rather be realistic. And that's the starting point. If the model's being prepared for your own internal purposes, I would actually lean towards being pessimistic. Again, our goal is not to ensure where we will be, but rather that we have enough cash reserves or financing to get through this process. So when forecasting your income statement, our starting point for forecasting the income statement is revenue. And I recommend recognizing revenue for committed contracts and limiting any consideration of non-committed or new business at this point in time. I also recommend trying to break your expenses down between fixed and variable costs. Some expenses will be part fixed and some will be part variable. And after you've done that, after you determine what fixed and variable costs you have, you should consider performing a break-even analysis. Basically, what level of revenue do we need in order to result in zero net income? In forecasting your balance sheet, we need to forecast what changes are going to occur in working capital. So particularly our accounts receivable, our inventory and accounts payable we just talked about, we need to anticipate timing and amount of capital expenditures that are coming. We also need to consider the financing that we already have in place, including repayment of existing debt and any additional financing if it's going to be applicable. And then if there are any other assets or liabilities not considered above, really we should be looking at anything that will impact our cash flow over the period we're projecting, forecasting, modeling. And so the big question I get is, how long are we supposed to predict COVID-19 slowdown for? And well, obviously at this point, no one really knows. I recommend allowing some flexibility in your model to account for that so that you can change as new information becomes available. Now, one recommendation I'm hearing back from banks that are advising on the business credit availability program forecasts are to consider 6 months at current levels or lower if you expect a further decline, 3 months of ramping back up to normal levels, and then 3 months at normal operating levels for a 12-month period. And we can certainly hope that the actual time frame is much shorter than this, but it does give us a starting point for consideration. Now, forecasting, our previous example, we're going to revisit. So in the previous example, we had $6 million in revenue, so that's $500,000 of revenue per month, and up to February 29th, 20, everything was status quo. We have a normal business. So the changes that happened after February 29th, 2020 are that revenue is going to decline in March, or did decline in March, to $300,000, and we're expecting only $100,000 each month for April to July. And then August, we're going to start improving, $300,000, September improving again. October to December, we're back to normal levels. Our customers, where we were always 2 months in receivables before, they're going to take 3 months, starting March 2020 and on through the remainder of 2020. Inventory, in order to allow for us to be able to ramp back up, we've made the decision that the same inventory level will always be maintained, $700,000. Accounts payable, we consider our suppliers to be key and will maintain existing policies of paying balances within 2 months. Okay, so what I've done on the next 3 slides, and I apologize if you're reading this on your phone, good luck, you will not be able to see this, but the slide deck is there, we've checked and it's readable in there. What I've done is forecast the financial statements on the next 3 slides, your income statement, then your balance sheet, and then your cash flow, okay? For this purpose specifically, I've ignored any government assistance. So any of the programs that are out there that we're going to talk about later on, I've not included in this analysis. It's just a starting point to determine where our cash flow will be without any assistance, any help, okay? On the income statement, you can see everything up to February was status quo, and we projected then in our revenue, and the revenue feeds these calculations as we go on. What you'll see is that we have small losses starting in March, and then bigger losses in April when we really ramp down, and then a small loss again in August, ramping back up to profit, and then full operations back in October 2020 to December 2020. Now, based on just the income statement, you'd likely look at this and say, well, here's my bad situation. Well, I should be using after tax, so it's really this. And we're probably going to be in our bad cash position right around August, okay? But on the balance sheet, when I flip forward, what you'll see is that we started the year with $50,000 in cash, and our cash crunch is actually here and here, which is a little bit unexpected. So we have cash crunches in March 2020 and again in December 2020. And the latter is probably more interesting to everyone because as we were operating at normal levels for 3 months, everything's back to normal. Our worst cash position is actually after we're back at normal levels. So I'm going to go through both here, but in March 2020, even though our losses, so this is our cash flow statement on the next page here, even though our loss from operations is only about $9,000, our changes in how we deal with accounts receivable going from 2 months to 3 months, and the fact that we had less overall expenses and therefore less payables resulted in, instead of $10,000 of cash outflow, we ended up with $450,000 of cash outflow. And then in December 2020, again, the difference here is not about the operational cash flow, but our balance sheet. We changed from everything's back to normal now. Yes, our operational cash flow is bad, but between February and December, the change was really, we went from having accounts receivable of $1 million on that same level of sales per month to $1.5 million, which resulted in the use of $500,000 of cash. So obviously these results are specific to this specific example, but hopefully it just reinforces the need to consider the balance sheet as well as the income statement. So next slide we're looking at is, so again, this was just the summary of what I did there and went through, but improving our cash flows, where do I start? So we've built out the model and the picture is pretty bleak. We need to improve the cash flow of our business. Where do we start to look? Okay, so, and my My caveat on all this is, before we start looking at any of these things, really we have to be mindful of the long-term impact of each decision on your business. If it's something that's going to impact your business long-term, you really need to watch that you're not doing something to jeopardize the future of your business. So just going through them quickly. First one is be creative with your product or service. We've always sold product A, B, or C. Those aren't selling right now. Are there any other similar or revised products that could be sold like right now? Something that's a modification of what we do. Now, what if production's been completely shut down? Are there any opportunities to convert production to support the fight on COVID-19? I know lots of manufacturers are changing over and creating face shields, PPE, masks, things along those lines. Are there opportunities there? Next piece is definitely you need to be focused and actively managing your business billing and collections from your customers. You need to be communicating with customers to determine, is there a mutually agreeable timeline for payment or extension of payment as necessary? Now, the next piece is your suppliers. You do need to be contacting your suppliers and asking similar questions. So you can't, I would not recommend unilaterally extending terms with your suppliers, especially if they're key suppliers to your business. Otherwise, you could create an issue down the road. At the end of the day, if they're a key supplier to you, you need to make sure that that relationship is strong, such that when you're ready to ramp back up, that relationship is still intact, that you're still able to go and get the required quantity and quality of inputs that you need to support production in a timely manner going forward. Number 4 is review your lease obligations, contact your landlord to see if there's any opportunities there. Please also note that there will be an announcement, or is an announcement, coming very shortly in the near future on the Canada Emergency Commercial Rental Assistance Program, which we'll discuss a little bit later on. And I also just heard on the news this morning that the Gap is suspending $115 million per month in North American rent payments and is in talk to negotiate or terminate its leases. So just an example there. Number 5, delaying your capital expenditures. This really depends on what the capital expenditure is for. If it's really required or critical to operations, you don't want to be delaying something that's going to shut down your operations, obviously. But if there's things that were planned but not required, maybe we look at delaying that till such time as things improve. Calling your lenders. This is a big one. All businesses should be in touch with their existing lenders, as the government's created a number of programs to assist with accessing capital. And the first point of contact is your existing financial institution for that. And also your existing financing, if you have some, there may be opportunities for existing lender to look at some type of deferral program on principal repayments, or extending terms, or accessing additional credit, expanding the line of credit, for example. Number 7, consider your staffing requirements. This is probably one of the hardest things to do and to consider on the list. Obviously, if you've got key people, you want to ensure that those people are kept employed and they're with our business and will continue to be post COVID-19, so we can ramp back up. And the other thing to think about here is you really need to consider what your staffing requirements are, what the cost of those staffing requirements are, and whether or not you qualify for temporary wage subsidy or the Canadian emergency wage subsidy, both of which we're going to talk about very shortly. Now, if you've got your slide deck, one of the changes that's in here, I flipped these two, that take advantage of tax deferrals and take advantage of government incentives. So 8 and 9 are flipped if you're looking at your slides versus looking at this presentation. The only reason is we're going to talk about government incentives next, and tax deferrals are the last slide in this. So we're going to move on now to our government support. So just a quick overview again. I refer everyone back to the previous website that I put on, I think it was slide 3. Our landing page has all of these programs, because what I'm telling you now may be different in a week's time. It may be different in 2 days' time. We'll see. As I see it right now, these are the key programs that exist to support businesses up to April 21st, 2020. And again, refer you back to our landing page, because all of these, minus the Canada Emergency Commercial Rental Assistance Program, are talked about on that. There's full details, there's links, there's ability to get more information. We have presented on some of these measures already. So there's a recorded webinar on some of these programs available. I've also attempted to include more details in the following slide, but you'll see right now I'm on slide 31 of 68. I'm not going to go through all of the rest of the slides. I'm going to try and give an executive summary on each of these programs. Okay, flipping through quickly. First one is the temporary wage subsidy. High level represents 10% of remuneration paid from March 18th to June 19th, up to $1,375 for each eligible employee and a maximum of $25,000 per employer. We're recommending to most clients that even if you're eligible for the Canada Emergency Wage Subsidy, you should still be claiming this. And the reason for that is this is claimed and it's a reduction of your source deductions, the tax paid on your source deductions. So you're getting an immediate cash inflow or a reduction of cash outflow at least. And then you're not having to wait. The CEWS, while you'll be able to apply starting Monday, you're only able to apply for each 4-week period. And that 4-week period will be paid at some point in the future. So you're talking about a month's wait plus another whatever 2 weeks to get the actual money in your hands. And then anything you claim from the temporary wage subsidy is just a straight reduction to the CEWS. So there's no double counting, but it improves your cash flow. And you'll see we've got more slides here as to who's entitled, books and records you need to keep, what it's considered, whether it's taxable or not, and so on. I've kept the slides in there, but we're not going to go through them. Okay. Again, the next piece is the Canada Emergency Wage Subsidy, and this one is a very large program. The executive summary we have is it's up to $847 per week per eligible employee for at least the 12 weeks from March 15th to June 6th. And the legislation allows for that to be extended through to, I believe, October without any need to get the legislation approved through Parliament again. Now, there's different rules that apply to new employees versus pre-existing employees, and there's different rules that apply to arm's length versus non-arm's length employees. And arm's length versus non-arm's length, basically think of it as family members of owners. All right. The application for the first claim period opens Monday, April 27th. It will open. So you can start claiming CEWS and get the subsidy and get it paid back in a week or 2 weeks or whatever it takes for them to actually physically get the cash to you. Now, our pro tip here is the legislation that's been released on this is very difficult to understand, even for an accountant, even for tax accountants. For business owners, it will be very difficult to ensure that you're on side and you've thought through everything and applied appropriately. And the issue we see with that is that if you apply right now, the way that things are done up, the first time you apply, that is the application you've made. I don't know that you're going to be able to go back and modify that or revise your claim. And so if you made a claim that's too much, that's a big issue because there's penalties for doing that. Or if you made a claim that was too low, you may not be able to go back and fix that. We don't know yet. That's the problem. All the legislation that's been put out now has been put out in a very rushed fashion. We still have questions as to how to apply this on specific client situations, and we will hopefully be helping our clients to better understand this. But there's a lot of information out there, and it's not entirely clear. There's lots of situations that require interpretation. Okay, and you'll see there's lots of details in the slides about how this works, the calculations, who's eligible, specific situations, how to apply. Here's the one slide here. This is the newest information that's out here as of April 21st. So on April 21st, a new website was put out there by the Government of Canada to assist business owners in calculating this claim, this subsidy. And there is actually an Excel worksheet that you can work through for each of the periods to help you with this. Now, that worksheet, it's a good starting point, but there's still things that you need to know. There's still ways that you can make mistakes. If you follow the template that's there are issues with it. So this is the actual calculator, worth a look. The website, though, you do need to do, because this only calculates the actual subsidy on wages. There are other things that need to be considered, such as CPP and EI from employer portions. If you've got employees that are off, you're paying them still, but they're not working, you can claim those back. It also doesn't consider if you've already claimed under the TWS, the amount that you've claimed there, or if you've claimed under the EI Workers Share Program, this part here. All right. Next piece, financing programs that are out there. There's been lots of announcements out there that the banks are trying to free up capital to allow for working capital or operational loans. So what we have is the first one that was announced, and hopefully everyone knows about this because it's already available, is the Canada Emergency Business Account. And effectively, if you qualify, and the qualifying really is just, was your payroll between $20,000 and $1.5 million for 2019, you can get up to $40,000 of interest-free government guaranteed revolving loan. And if you repay that loan before December 31st, 2022, 25% of the amount you received will be forgiven. If not, it converts to a 5% interest loan, 5% interest loan after December 31st, 2022. Applications are available now. You go through your existing financial institution, and my understanding is the application process is really straightforward. It's about 3 questions that you have to answer. The next piece we've got is the Business Credit Availability Program. And for small and medium-sized credit-worthy businesses, so SMEs that are credit-worthy, and credit-worthy is the key here, the loans will not be approved to businesses that were struggling prior to the pandemic. And BDC and EDC are co-lending, are working with your existing financial institutions for these loans, and these loans can be up to $6.25 million right now. Now, EDC will also be working with financial institutions to potentially guarantee up to 80% of new operating line or working capital term loans. But the full details of that haven't been announced based on discussions with EDC. I believe there's more information to come this week or potentially next week. So that some financial institutions have some information around that, some do not. Your existing financial institution is your starting point for all this stuff. So you should be contacting your financial institution to start the application process if you need it, because there has been a huge demand, high volume for these applications, and they're backlogged significantly, I believe, based on my discussions with BDC and EDC so far. If there are businesses on this webinar that are not considered SMEs, small to mid-sized enterprises, again, based on discussions with EDC, I believe that there's expected to be a program to be announced in the coming weeks to support mid-market businesses. Effectively, if you end up needing more than the $6.25 million that's been allocated under the VCAP, this program should be there, but there's no real timeline known on this at this point. Okay, the last program I'm going to talk about is the Canada Emergency Commercial Rental Assistance, which I'm guessing most people may not have heard a lot about because this is all the information that we have at this point. So the announcement by the federal government came out on April the 16th, last week, and on an intent to create an additional program for small businesses. The program will seek to provide loans, including forgivable loans, to commercial property owners who, in turn, will lower or forego rent for small businesses for the months of April retroactive, May, and June. Implementation of the program requires a partnership between the federal government and the provincial and territorial governments, which are responsible for property owner-tenant relationships. They're working with the provinces and territories to increase the rent support for businesses that are most impacted by the pandemic, and we'll have more details to share soon. This is the theme, more details coming. So the last piece that's in my slide deck here, tax deadlines and tax payments deferrals. There are a few very narrow, very limited, won't have a whole lot of impact on cash flow, but there are some tax deadline changes and tax payment deferrals that exist. They're detailed here, but I don't think it's going to impact most people's cash flow very much. So I'm not going to talk about them. Sorry, backwards instead of forwards. And then next piece is questions. I will also flip forward to the other disclaimer that's in our notes here.
Thank you, Scott, so much. And some people can't hear me potentially, so when I ask you a question, just please repeat it or summarize it. There are a couple of questions that have come in about the financing programs, but we have some questions from before about the cash flow piece. I just want to ask you these. So the first one, so when there's outlier events, things like this, like a big spike in bad accounts receivable, where, I don't know, 20% of accounts receivable are not going to be able to be collected or something like that. How can somebody try to forecast that in? And then how do they keep chasing it, or should they keep chasing it when they're already in a cash flow crunch and don't have the resources to do that?
So again, trying to predict out everything that's going to happen during COVID-19 is really, really difficult. I'll be the first to admit that. In terms of bad debts, again, one of the things we want to see is what the guarantees that's coming through from this BCAP program look like. My understanding is there will be a cost to it, but they're willing to guarantee some of the financing depending on what happens around that. So we don't have the details as to how to account for that at this stage, but for your own purposes, it's connecting with each of those customers and determining, are they going to be able to pay, when are they going to be able to pay, or are they not going to be able to pay, and then what does that do to our cash flow?
Great. And when you're meeting with clients, are there any kind of normal bills or normal account payables that companies keep paying that they don't even think about deferring, or think about that they can negotiate down on, that they should maybe start looking at?
So in terms of specific people that they're paying that they should defer, or who's the first person to stop paying?
That was the question in my head. I could think of maybe like a cell phone. Maybe companies have a cell phone bill and they don't think that they can negotiate down with their cell phone carrier a reduced payment or a deferred payment. Like are there things like that you see all the time that companies are just not looking at?
Well, in terms of whether they're still going to have to pay it, and if you're doing it if you're talking cell phones, you're going to be charged interest and late penalties on not paying it. So it's the ones that you can negotiate with that will be open to extending terms if they are. And if not, it's is it more costly to take the penalty from them or to go out and finance it ourselves?
Right.
Again, the idea with all of this is hopefully over the course of a year, things will go back to normal. So there's a short-term period where we're going to need additional cash flow to get us through to when things are back in normal. Now, again, that assumes that this situation only lasts for 6 months or 3 months or whatever it is. If
and
it's
I
going
think
to last
that's
much
the
longer.
The next question that I have here too, because you were talking about capital expenditures, and somebody was asking about deferring. If they have a factory or a piece of their business that would only take 2 months to get into operation, but will still cost quite a bit of cash today. Mm-hmm. How do they try to weigh in if they'll be able to have it in line 3 months from now, or they'll have to wait for 12 months? That's the question. I guess you're just wondering how to try to weigh the unpredictability of how long they're not going to be able to have it in operation, even though there's only a couple months left till they could get it in operation.
Right. So at the end of the day, it comes down to what your capacity is, and do you need that space for capacity? So I've presented this on the assumption that most people are having cash flow issues right now. Not all businesses are. In fact, I've got a good example of a client that's going to double in size for revenue and needs to double the line size that they've got. So they're going out to get financing to expand. Now, that's because they're producing an essential supply right now that's really in demand. And so in that case, they're absolutely going out financing and doing the expansion now because it's the impediment to them increasing their capacity, improving their cash flow, and growing things beyond where they are, more than double where they are now. So each individual business has to consider whether if it's a line capacity issue. So it comes down to, we're at capacity now. Okay, that will help us to build capacity, and then that improves our cash flow. That's great, then you should be doing it if it's positive in terms of overall cash flow long term. But if it's uncertain right now that we're at a stage now, but we don't know that our sales will continue to go, then it might be something that looks at being deferred until such time as there's more certainty around what's going to happen going forward.
Cool, great. And the last one I have, and then there's questions here about the financing programs, is somebody asked about payment models for clients. So they've historically just, I guess, let's just say they've always just issued a bill and then the client's paid 30 days. But they're looking at doing like a monthly pay model for their clients, and they haven't done that before. So I think they're wondering. The question is about what is it like when they were finding a third-party company that would help pay them the full amount of cash now, and then that company collects from their clients instead? They just don't know.
Talking about factoring accounts receivable then?
Pardon? Say again?
Are they talking about factoring accounts receivable then? Selling them to somebody else they collect on their behalf?
Yeah, so I think, yeah. So that's what's not in here. That was the word I was trying to think of in my head. Yeah, they're looking for a factoring service and they've not considered it before. And is there any advice you have around that?
I can't give them advice on the factoring side of things. I'm not a major fan of it, but from a cash flow perspective, it does improve very short term, but recognize that all you're doing is effectively financing that receivable at a very high rate normally.
Okay, great.
So one thing that you should think about there, because it kind of leads into a different question, is do you have something on your invoices or a contract with your customers that say you shall pay in X days, X months, whatever it is, and what the penalties are or the benefits are in paying in 10 days versus 30 days, or if you've unilaterally gone beyond the time that you're supposed to have paid it, what penalty is it interest, is it whatever, but that should be written into either a contract or specifically on your invoices. So we have it ourselves on our engagement letter, so our clients have it, it's in that. And then on top of that, our invoice says at the very bottom, paid in X days, and if not, we charge an interest rate of 2% per month, I think it is.
Right, which is beautiful, because obviously if other businesses are sitting here right now with 3 account payables in front of them wondering which one they should pay and which ones can they defer, and you don't have a reason why they should pay you early or penalty to pay you late, then you might drop to the bottom of the pile for that payment cycle right now. A couple questions on the federal relief program. So one is somebody asking, and again, I will say that some of these questions, and Scott, you can say go to your landing page or watch the previous webinar, because we don't want to go too far into the weeds here. Single employee corporation can they apply for like the CEWS if they're the only employee?
So as long as they were paying themselves a regular wage from January 1st to March 15th, yes.
Okay. And if someone's just over the, don't quote you on that.
One thing I will look at here. So there was a question that just came up. I just lost it. Something about audit.
I'll look for that.
What are the likelihood of being audited on these things? I would expect there will be a very high. In fact, I would expect that CRA is going to create a group just to deal with audits of programs under the COVID-19. And they've already announced in the legislation, in the CEWS legislation in particular, that they are willing to name and shame businesses that act in bad faith. And there are big penalties for acting in bad faith as well. So I would say the likelihood of audit on these is extremely high, and that you need to make sure if you're putting a claim in for the CEWS, you need to have all your documentation lined up so that this is not an issue down the road. You don't want to be going back to try and create all this documentation. You've got it now. But yeah, I agree with the comment that was just made. So on top of all the other stuff, you're gonna have CRA audit and creating work. It's creating work for their employees, right? So they've got to keep their people busy too.
Henry asked a question a little bit ago that they're just over the $1.5 million threshold, and they're wondering if there's any kind of deductions, like deducting T4 income paid to shareholders or anything like that could drop them below.
It's a straight, this is what your T4 said in 2019. In fact, the application is, again, it's very straightforward. I think it's enter your payroll number, enter your gross wages, and then submit. I think that's it. So
And
you either do or you don't. It's a very black and white scenario. There's nothing more to do on the CEBA.
for businesses that are brand new, so just started up in, let's just say started up at they started this year, so they haven't actually done a tax return. Are they out of luck, or how can they participate?
So they're out of luck on the CEBA. So that's the 40,000, but they are included in the CEWS. So if you've got a business that's just starting up, let me see if I can go back to my slides here and find that exact, but I don't know that I actually put it in this particular piece, but the criteria to meet, and it is there, yes, actually. So hold on. The criteria to meet is that you were 15% or 30% down in the reference period. Reference period being March 2020 or April 2020 or May 2020. So if you didn't have a 2019 year, you don't have anything to compare it to. But what the government did is recognize that you can opt or elect to choose to compare to the average of January and February 2020 compared to March, April, May for this claim period. So when they do that, if you're a startup, if you're really early startup and you're down to the level of you started in March 15th, sorry, if you start in March, there's no claim. You can't get the CEWS. If you started in February, it's the number of days. So the revenue divided by the number of days that you're in operation that you're compared to. So startups can still qualify. Again, refer back to the actual section that we have on the CEWS. There's lots of details around that going forward, okay?
Okay, great. Question here about Canada versus US revenue and converting back to a single currency, and I guess kind of strategy around that, or I'll just leave that to you. You seem to know the question.
Yeah, so we're getting off the topic of cash flow management, but here for the CEWS, it's my understanding is it's Canadian-based business only. So as long as it's your Canadian business selling US, it's okay. But if you have foreign operations, that all has to be excluded. So if you have a US location that's selling, that's excluded from your business based on what's out there. But again, refer back to legislation, make sure that that's appropriate for your business. The other piece to think about there, you said US currency and conversions. So the revenue tests that are out there all say that you have to follow your normal accounting policies. And we've had questions from people on this too, is can I stop recognizing certain things that I used to recognize in revenue and record them as instead reduction of expenses so that my revenue looks like it's dropped 15 or 30%? The answer is no. You're supposed to follow the way that you were doing the accounting so that it's a consistent apples to apples comparison, that you're not manipulating the numbers to see that you qualify. And I expect that they will audit that as well.
Okay, great. And this will be my last federal financing funding program. So it's around the CEBA, and some Deb is wondering if there's anything that's stipulated in there that says they cannot, cannot apply for any other program at the same time. So if you do apply for CEBA, you can't apply for the TWS or the CEWS.
There's nothing. My understanding is there's no restriction on it. If you're eligible to claim the CEBA, you can apply for any other programs that are out there. There's nothing that says that you can't claim other programs that I'm aware of.
Okay, yeah, and Deb's pointing to there might be something in the letter of agreement that people are discovering now. So maybe that is something new, but again, that would be why it's good to get a second set of eyes on these before you sign off on them. Scott, is there anything you want to say here to round this out for us?
No, I just hope that everyone understands where we're coming from here. And again, my point is, when you're forecasting this out, and you're going to have to, if you're applying for any of the financing that's out there, the BCAP program, they've specifically asked for a forecast for the next 12 months or 2 years, depending on where you are at in your cycle and where your previous year end was. At the end of the day, you need to be forecasting. So some of the models that are out there only forecast the income statement. I think that's a mistake. You're missing a big piece if you're not considering your balance sheet as well. And again, the ability to build this out, it's not a one-time document. It may be a one-time document for what you're providing to the bank to apply for it, But my goal would be that you build it out such that you're able to take that and be able to adjust it as changes come.
Okay, thank you, Scott. And thank you again for putting in all the time before this webinar that people have no idea you spent updating and keeping up to date on all of the different changes happening every day to make sure that we had the most up-to-date presentation today. Scott is available, and the entire team at Baker Tilly is incredible. So I'll make sure you have Scott's email after this. And if you do have your own team in-house that's rocking through this in terms of, you know, effectively managing cash flow and providing prudent decision-making, wonderful. And if you do need that additional ear to lean on or team to support you, a team like Baker Tilly is just amazing right now. So again, Scott, thank you so much for being with us. Thanks everybody for all the questions. It was a real pleasure. Have yourself a wonderful day. Take care. Bye-bye.